Today we have Lily Tron. She's an enrolled agent and certified tax coach from TaxiSign. And we have Sarah Huang, CPA from Clark Newber. And now I would like to turn it over to Lily.
Hi, everyone. I'm Lily Tran. I'm an enrolled agent and I specialize in taxes and I can practice in all 50 states. So today, I do require a little bit of participation. So what I would like for you to do is use the Q&A box to answer some questions I have for you, okay? Next slide. Let's go to know your business entity, all right? Do you know your business entity? I want you to use your chat box and put what your business entity is. Are you a sole proprietorship, a single member LLC? When you have a, so it's important to know your business entity because it's important to know how to do your bookkeeping and how to file your tax return. So if you're a sole proprietorship, a single member LLC, you file a Schedule C with your personal tax return. If you're a corporation, you file the Form 1120. And if you're an S corporation, you file a Form 1120S. Now, if you're a partnership, you file a Form 1065. Now, if you are married and you live in a community property state such as Washington State, being married, you can elect to file a qualified joint venture, which means you can file 2 Schedule Cs, okay? Next slide. All right, now when you know your business entity, it's time to do your bookkeeping. Bookkeeping is important to track your income and expenses. These are some accounting software that you can use. QuickBooks Online, Xero, FreshBooks, Sage. What software or how do you track your income and expenses? Put it in the chat box there. Next slide. All right, like I said, it's so important for you to do your bookkeeping. Why? Because bookkeeping plays a crucial role in tax preparation. Bookkeeping helps you track your income and expenses. So if you're doing your own bookkeeping, I strongly recommend that you get it reviewed. Okay, next slide. All right, so I'm going to talk to you today about bookkeeping for your COVID-19 relief funds. All right, so if you received Employee Retention Tax Credit, ERC, the Paycheck Protection Program, PPP, the Economic Injury Disaster Loan, EIDL, I'm going to show you how to track this COVID-19 relief funds in your books. All right, next slide. All right, so this chart tells you how, more information about ERC, PPP, EIDL, all right? So with the ERC, it's a refundable payroll tax credit. Now, is it forgivable? Well, the full amount is refundable if not used up. The PPP, it is forgivable, and the EIDL, if you receive the EIDL advance, yes, that's forgivable. But if you receive the EIDL loan, that's a loan, so that is a loan that you need to pay back. All right, next slide. All right, here we have how do you record the funds deposited into your account? So let's say you received a PPP loan. You record that as a long-term liability. So that goes on to your balance sheet where you have your assets, your liability, and your equity account. It doesn't go on your profit and loss. Now, if you receive the EIDL grant, you would record that as other income. And the EIDL loan is also recorded as a long-term liability. Now, if your PPP loan is forgiven, you take the loan that's on your long-term liability and you move it to other income. Next slide. All right, so the date that you receive the funds is the date you record it into your bookkeeping. So the PPP, the account, you can use PPP loan payable. The EIDL grant, you can put it as EIDL grant as other income again. And then the EIDL loan is the EIDL loan payable on the balance sheet as a long-term liability account. Okay. All right. So are these taxable on your tax return? Some are and some aren't. Okay. So if you receive the federal, I didn't talk about this in the other slides, but for federal and state grants, they are taxable on your tax return. If you receive the PPP forgiveness, it's not taxable. However, I would strongly recommend that you check with your state because it can be taxable based on what state you live in. The EID grant, the advance money that you receive, is not taxable. And then also the loan is not taxable because it's a loan that you have to repay back. Next. All right, so remember when I said you need to know your business entity? It's when you know your business entity, you can look at the schedule, like Schedule C, if you're a Schedule C filer, or maybe you're a Form 1120S, a S corporation. You can look at the form, you can look at the schedule, and you can see all the different expenses on there, and you can use those expenses as categories in your bookkeeping software. Okay, so these are just some common expenses from the Schedule C, advertising, car, truck expense, salary, wages, and so on. Another expense, when it comes to the car and truck, you can depreciate it. So let's say you take the car, you use the car in your business, and you have to use that car more than 50%. And you can either track your mileage, take the mileage, the standard rate mileage rate, or the actual expenses. On the next slide are example of the depreciation items. So like I was saying about the car, right? So depreciation, like you can depreciate the car. So whether you take the actual or the standard, you would depreciate your car. So basically, let's say last year I buy a car for $10,000 and that car is placed in service. So it has to be placed in service last year. And I buy a car for $10,000 and it's useful for 10 years. I can depreciate $1,000 per year for 10 years. Those are, that's how the regular depreciation, how it works, okay? And here are other items or examples of depreciation items: equipment, machinery. Let's say you copyright materials, buildings, and the car, like I said. And then there is also what is called bonus depreciation on the next slide. So there's bonus depreciation. There's also Section 179, which I don't have a slide on, but bonus depreciation is a tax incentive that allows business to deduct a larger percentage of their purchase price. So instead of writing off, over the useful of the life of the asset, you take a bigger bonus depreciation. So in 2021 and 2022, you can take 100%. And then in 2023, it goes down to 80%. And then the following year, it goes down even more. So bonus depreciation, what I would recommend so you can either opt in or opt out for bonus depreciation. So you might see on social media where people are talking about like, oh, you can buy a car, take 100% bonus depreciation on the car. What I would recommend that you do is, instead of you deciding which one, is working with a qualified tax professional to find out if it's best for you to take this bonus depreciation, or if you should do a regular depreciation. So on the next slide here, like I talked about, 2021 and 2022 is 100% bonus depreciation, and then they start to go down 80%, 60%, so on. But you have to remember that in order to take it, you would have to place it in service in the year. So like if it's last year, you would have to have that asset placed in service last year, not this year. So if I buy equipment last year and I put in the service this year, that means that I can take the bonus depreciation in 2022. And the other important thing to know is that the item needs to be new to you. It doesn't have to be like a new item, but it has to be new asset that you've never used in your business. So let's say I've had the car and I've never used the car in my business before, but last year I decided to use that car for a business. That's new to me. So I can take that bonus depreciation on the car if I wanted to, right? So on the next slide, so on my website, if you go onto taxdesign.com, you can download a year-end small business checklist. So when you go onto the website, this window pops up, you type in your email address, you download the business checklist. On the business checklist has these items like inventory, if you have inventory, your home office, business use of vehicle. It just helps you gather your tax documents and also to gather information to prepare for tax season, whether you're doing it yourself or you're working with a qualified tax professional. Okay. Same with the next slide. Other items on the checklist that you can see there. Talking about depreciation that I just went over. If you have a bookkeeping software that you're using, I always recommend, like I said at the beginning of the presentation, is to, if you're doing it yourself, to get it reviewed, because we want to make sure everything is classified to the appropriate accounts. And if you have any items that are unknown, I always recommend to put in ask my accountant if you're not quite sure, but in the memo, just put some information to help whoever is reviewing your books to know how to classify the expenses. Okay. Okay, so remember when I said know your business entity? So why is it important to know your business entity? It's important to know your business entity because then you know when the taxes are due. Okay, so on the next two slides there, this one here, the tax due dates, the next slide is if you operate your business in Washington State, you may need to file a excise tax return. Okay, so when you register your business, you receive the letter, and on the letter it will tell you when you need to file. So you might be on monthly, quarterly, or annual. Okay. You may also need to file a city excise tax return. All right, on the next slide there are other due dates for this month. If you have employees, or maybe you're an employee of the corporation, you would need to issue W-2s, and that's due January 31st. Also due on January 31st is the 1099. So if you have contractors where you paid them in cash or check, $600 or more per year per person, you may need to issue them a 1099. And that's due January 31st, but obviously there's other due dates here that you can take a look electronically and stuff like that. So that's the due dates for W-2s and 1099s. And on the next slide, about your business entity. So if you're a S corporation or a partnership, it's due March 15th. So again, know your business entity, then you will know when the taxes are due. April 18th. So normally it's April 15th, but this year, April 18th on a Monday, your personal tax return, the 1040, and the C corporations are due on April 18th, okay? As well as January 30, is not on there, but the estimated tax payments are due January 18th. So on the next slide, so if you're unable to file by the due date, I recommend that you file an extension. Okay, so you can't meet the deadline, file an extension, and it gives you 6 months to file. But that's just to file, okay? If you have taxes due, I highly recommend that you pay the taxes by the due date to avoid any penalties. So there's a failure to file and failure to pay penalties. Again, do your best to file on time or file an extension, pay your taxes on time. If you're unable to pay your taxes on time, reach out to a qualified tax professional, book a one-on-one with me. We can talk about some payment plans that might be best for you. If you file an extension, the partnership and the S-Corps are due September 15th. If you for your personal and your C corporation is due October 17th. All right, and then there's also the estimated tax payments in there as well. So like I said about the penalties, there are penalties for failure to file, failure to pay, accuracy related fraud and stuff like that. Hopefully you don't end up in fraud, but yes, make sure you file and pay on time, right? That's how you stay in compliance. All right, so on my website, you can download, again, the year-end small business checklist. I do have a tax prepped client checklist. You can reach out to me or book that one-on-one with me, and I can provide a checklist for you. There's a tax organizer as well that you can find on my resource page. I am launching a book, publishing a book later this month, and I'll have that pre-order book available. It's called The Most Common Tax Mistakes Made by Small Businesses. All right, if you have any questions, leave your questions in the Q&A there. And next up is Sarah.
Thanks, Lily. A lot of info there in a quick 15-minute session. So we're going to switch topics a little bit and focus on not-for-profits right now, because I'm sure that we probably have a couple of not-for-profit organizations on this webinar. So, but some of this stuff will apply to all organizations as a whole. So not-for-profits, not a whole lot has changed for them in the year ahead, but they are finding that there are some pain points, especially when it comes to the IRS. So we'll talk a little bit about what to do if you get contacted by the IRS, and or even how to contact them if you're still trying to file a tax return or check your refund status on something. We'll also just do a quick reminder on donor receipts. That's always the big thing for not-for-profits, especially right now, this time of the year, because that's when all your donors are calling you, asking for a receipt for their own personal tax returns. We'll talk about COVID relief funding, how to report that on your annual Form 990 and what some of the options are there. And then a couple quick reminders on single audits. I know that's been a thing that we've heard a lot of organizations come to us with questions on, especially in light of all this government funding that they have gotten the past year, is that now it's triggering single audit requirements. So we'll talk about what that means. And then lastly, we'll quick touch on state tax filings. With a lot of people going remote, we're seeing more and more state tax filings come up, whether it be for employee taxes or even just registering in different states for charitable solicitations and things like that. So delays at the IRS. I know everybody is experiencing this. It's super frustrating as a taxpayer, as well as, a tax advisor too, because we're getting questions from clients on where their refund status is, where their tax return is, when can they get their money, when can we get this notice resolved? And we just simply don't have answers. So I guess the big thing that I can just remind everybody is that the IRS is human too. We're all experiencing issues with COVID, whether it be, our own families are getting sick, or people that we're working with are getting sick, or clients are getting sick. And the IRS is too. I mean, they're having the same problems with their staff, which is causing enormous backlogs that we have honestly never seen before this bad. And honestly, it's probably not going to turn around anytime soon. So just be prepared to wait. If you're calling the IRS, be prepared to be on hold for a long time. And yeah, it's going to get frustrating. You're going to get notices in the mail, But the IRS, they're aware of the problems, they're trying to fix it, but it's going to definitely take some time for sure. Go ahead and go to the next slide. So if you do get some sort of IRS notice, and this is both for-profit and not-for-profit organizations, definitely check the IRS website because they do have a lot of data on there on answering various questions when it comes to different issues that come up. So definitely check the website there. If you can't get an answer through the website, maybe your issue is very specific to you, then try calling the IRS. This number here is specific for not-for-profit organizations, but you can look on the IRS's website and find information on all types of entities and give you that phone number to call for that specific type of tax issue that you are facing. I will say, again, be prepared to wait on the phone there. If you are trying to call maybe later on in the week, like a Wednesday, Thursday, or Friday. Don't ever call on a Monday because that's when everybody is trying to call. Everyone's gotten their mail from over the weekend and suddenly they have IRS notices that have popped up. And so don't try to do that. For us here in Washington, if that is where you're listening from, try calling later on in the day because then those East Coast folks would have dropped off of the phone lines there. And if you're on the East Coast, then call early in the morning because then you don't have the West Coast people up yet. So those are just some tips there, I would say. And then if you're really running stuck, you could try the Taxpayer Advocate Service. So that's a free service that's available to all types of organizations. And they're kind of like a liaison between you and the IRS. So they have access to IRS records. They can pull additional information. They can help in getting those tricky issues resolved. I mean, don't call them if you're trying to check the status of your employee retention credit refund. I mean, that's just not what they are there for. But if you're getting all kinds of notices from your employee retention credit or getting notices from your personal income taxes or something, and you just can't get a hold of anybody at the IRS, that's when you may want to consider getting the Taxpayer Advocate Service involved because they can help kind of figure out what's going on and give you the best course of action there. Go ahead and go to the next slide. And so one quick reminder, again, this is both for not-for-profit and for-profit entities. We are seeing a lot of organizations move. And so they are downsizing in space because they just simply don't have as many people going to the office anymore. And so they're looking for ways to save money. If you are moving locations for your business, or maybe you're shuttering your actual office space and everybody's going remote. And so now it's just your own personal address that's going to be used as your business address. Make sure that you are updating this with the IRS. It's super important. It's a quick little form that you file, gets mailed in with the IRS. Technically, you're supposed to do it within 60 days. So just make sure that you keep that up to date, especially because we are seeing so many erroneous IRS notices coming through. You don't want those notices going to the old address there. Now, donor receipts, another topic for not-for-profit organizations. This is super important. There are 6 required elements that have to be in that donor receipt in order to allow that donor to get a charitable deduction. We see the IRS doing special issue audits where they go and select donors for audit, and they are specifically looking at the donations that are on their Form 1040 or their business tax return and making sure that they have donor receipts for everything. If they don't have a donor receipt, or if that donor receipt doesn't include everything it should, the IRS is disallowing the donor deduction. And now technically it's a donor's responsibility to get all of their required information to allow a proper deduction on their tax return. But donors don't know that. If their donor receipt is disallowed because something's missing, unfortunately, they're probably going to blame the charity instead. And so you as a charity, you want to put yourself in a great position. Make sure that you're including everything that you should here and that you're not leaving any of this stuff out. There's different ways to do it. You could do it via email. You can send a paper receipt. It could be something that gets printed off, the day of your event if you had something in person. But just make sure it includes all those elements. They're super easy things to include, your basic information on your organization and then the amount of the donation if it was a cash donation. And then a statement, that's always the last one. That's the last one on the bottom there. That's always what gets end up missed in the end. Just a quick statement on whether any goods or services were provided in exchange. So that's the situation where you go to the charity auction and then you get a meal for part of that's covering part of your ticket price. And so that value of the meal that you get actually reduces your charitable donation, and that's what needs to be disclosed on that donor receipt. Now, there was a special provision that was in effect through the end of 2021 for certain types of charitable donations, where if a person gave a cash donation, they could actually qualify for a much higher deduction on their income tax return. In this case, it was up to 100% for individuals. Normally, charitable donations are limited to 60% of their adjusted gross income, but there was a special provision out there for 2020 and 2021 that allowed for up to 100% there. So if you're a charity, make sure that your donor receipt includes any language about that special donation there. If you have donor advised funds or something like that, as you'll see on the next slide, those type of donations are not eligible for that special 100% deduction, but most of the time, most public charities will qualify there. Some private operating foundations, government donations, those will all qualify for that higher percentage there. So don't forget to include any special language about that donation, possibly in your donor receipt as well. So now when it comes to tax return reporting for COVID relief, we get a lot of questions on this. So for PPP loans, we believe the proper treatment is to report it as an additional contribution during the year, so additional revenue. What you'll see on the for-profit side of things, there's again some options there on how to record it, but then on your income tax return, it's going to be a book tax adjustment. So it's not actually taxable to you as a for-profit entity. For a not-for-profit, it's still going to go on the tax return because you don't pay taxes anyways as a not-for-profit organization. So you're just going to keep it on there as an additional charitable deduction. We don't have 100% guidance from the IRS that is how they want it to be done, but based on how the rules are evolving and kind of what we have heard from various groups around the country, we think that likely is going to be the proper treatment there. And the good news is that by recording it as an additional donation from the government, you're actually boosting your public support tests each year. So it's a win-win there. Now, when it comes to, if we flip to the next slide, other COVID types of tax credits that you may have gotten, the FICRA leave credit, I know that one was popular because a lot of people had employees that were sick with COVID. We think that also is reported as additional income, possibly additional contribution revenue. Again, not 100% sure, hoping that the IRS will provide some guidance when they finalize the Form 990 in the coming weeks ahead. And then the employee retention tax credit, this is one that we also get a lot of questions on too. For for-profit businesses, it's pretty clear that on your income tax return, that credit is considered a reduction to your salary expenses. So it's all part of those payroll taxes and such, and then it's just an offset to those expenses there. For not-for-profits, we think the same treatment is there, but we know that a lot of them, if you are doing a financial statement audit, you'll have picked it up as other income. So there may be, a situation where you have it as other income on your tax return. We're just not really 100% sure. So for now, we're just recommending people follow kind of the same advice that the IRS has published out there, which is netting it against your expenses. But again, be prepared for additional guidance from the IRS on that. And regarding the employee retention credit, I just want to put a quick plug in there just to let you all know it's not too late to apply for this. You still have a ton of time. You probably have about an additional 2 years, honestly, before that time kind of the clock starts ticking and you may not be able to get that refund there. We had a lot of organizations that initially looked at their eligibility and thought, oh no, we're not eligible. But now that the rules have changed a little bit, they're going back and finding that they are eligible. So if you have employees on your staff, definitely take a look at this credit because you may find that you're actually eligible. And the credit can be very substantial for your organization. I mean, we're seeing it for small organizations, it can be hundreds of thousands of dollars. Large organizations with over 100 or 200 employees, it can be millions of dollars over a couple quarters. So definitely take a look at this and recheck what the rules are. The IRS website is not 100% up to date, so just be aware of that too. Couple quick other tax updates to let you know about when it comes to not-for-profit organizations. If you're starting a new not-for-profit, you would file that Form 1023. That's all required to be online now. The IRS is also moving to the 1024 to be online, so just be prepared for that. The good news is that it now lets those applications go through faster and with less errors, and so it's actually a really positive thing that the IRS has moved that to an online-only system. And then regarding just your regular annual tax return, those now need to be filed electronically. So just a quick reminder on that. You're going to get a letter back if you try to file it via paper and said your return's rejected, you need to file electronically. So don't forget to submit that electronically. If you're filing your own Form 990, for your not-for-profit. There are some free online services that you can use, and some that charge a very small fee, like $100 or less. It's kind of a scaled approach depending on the size of your organization. But definitely check those out too if that's something that you take care of on your own. Electronic signatures have been a big thing and have really gotten us through COVID, honestly. Because as a tax professional, we're always trying to get that client signature so we can file the return for them. Well, the IRS had a rule that said you can't do electronic signatures. Everything had to be a wet paper signature. And with everyone being remote, that's kind of challenging. Not everybody has a printer and a scanner that they can print out the form and send it back to you via email or something like that. But the IRS now has allowed for electronic signatures, so sending something via DocuSign or one of those programs, and that will go all the way through October 31 of 2023, and this applies to for-profit businesses too. And so that's great news. It's definitely a relief to see the IRS moving with the times and allowing for some more technology there when it comes to filing your tax return. And then lastly, a quick mention, the IRS each year comes out with their indexed inflation numbers there for donations. And so that has come out now for 2022. So if you need those for your donation receipts in the coming year, then that's where you can find that information. So single audit requirements. I want to just quick mention this because some organizations have been asking us questions on this, and it also applies to for-profit entities too. So single audit is a special type of financial statement audit for those who are getting some sort of federal award from the government. And so federal government awards can be a variety of different things. It can be additional grants that you got, like a PPP loan or something, although PPP loans have a special exception to the rules because that would just result in a ton of single audits. But maybe it's a NIH grant or something like that. So something unique that you got during the year. And it has to be over $750,000 that you expended during that year in question. If you are over that threshold, then you're going to have a single audit requirement. It's not overly burdensome, I would say, but you just need to make sure that you get a tax preparer involved so that they can go through those requirements and help you with that special financial statement that you need to put together, because it is very specific. You do have to have very specific tracking mechanisms in place. All those federal compliance rules apply regardless of whether you are over that $750,000 threshold, but that $750,000 threshold is just when you actually need to do a formal audit requirement there. So just be aware of that. And then lastly, for state tax registrations, we are seeing so many state tax issues coming up. And again, this applies to both for-profit entities and not-for-profit entities. We have so many folks who are having employees move out of state. The wife works for the organization, but then the husband now is getting a job offer down in California. And so the family is going to move down to California, but the wife still wants to work for the company and the company is okay with it being remote. Well, what does that do to you as an employer? There's some very specific rules that come into play. You may be required to do additional payroll tax filings there. Well, you will, because that person is now working from California. For not-for-profit specifically, you have to register as a charitable entity in California. And California is weird because they don't just automatically accept your federal tax exempt status. You have to apply for your own separate tax exempt status down in California. It's a pretty easy process. We haven't seen anybody run into issues with it, but it's just an additional filing requirement to be aware of. So don't forget about those additional cross-border tax issues that may come up there. Again, we see a lot of people. I had one client who was having situations where they had a number of people who were here in the US from India, and a number of their employees wanted to go back to India and work remotely for like 4 months or 5 months and help take care of their family who was sick and things like this. This was before the whole Omicron thing had kind of come full swing. But they were getting a lot of requests from that. And so now you have to deal with India tax law and what that may mean. And the rules can be different depending on if that person is also a dual citizen of India or not. And So there's just a lot of unique situations that are coming up now. Our world has definitely gotten a lot more global than what it was before. And, a lot of businesses are allowing their employees to work outside of the office. And so that's creating just a whole set of additional issues. And so just remember that, make sure you know where your employees physically are located, even if it is just temporarily. I mean, maybe they're doing a 2-month stint over in Hawaii because they own a condo over there or something. Just make sure you're aware of that and know kind of what those payroll tax implications may be there, because you may need to register in that other state. You may have to do separate withholding there. There's a variety of things, and there's a variety of third-party payroll tax services that can help you with that, or you can also contact your CPA and they can help you figure all that out too. So I believe that's all that we have from our update. So I'll turn it back to Christina and we'll go through some Q&As.
Yep, it's time for Q&A. So thank you, Lily. Thank you, Sarah. A lot of information there. So we have some questions here. So the first one, more of a technical question, I think. If I didn't fill out the form to change my business address within 60 days, what should I do?
Just do it now. It's okay. We see that happening all the time. The IRS just wants to get it sooner rather than later. If you're not going to get any penalties or anything if you don't do it within 60 days, just do it now, so that way the IRS has it on record and you get your updated address there.
Oh, perfect. And we had a question in the Q&A box that was answered, but I want to go ahead and get it on today. It says, question on the ERTC. Did the employee retention tax credit end in the third quarter of 2021 for companies that was started before 2020? So I think a little more information on that would be fantastic.
Yeah, the answer is generally yes. So for most organizations, that credit ended as of Q3. There are special organizations, they're called like qualified startup recovery businesses, that basically formed during the pandemic. And those may be eligible to also take Q4 potentially for the employee retention credit, but there's a bunch of requirements that they would have to meet in order to be eligible for that. But the vast majority of organizations, yes, it ended as of Q3. There's been some bills floated in Congress to try to reinstate that for Q4, maybe even extend it into 2022, but so far nothing has gotten any traction.
Okay, great. And I'm going to keep on the employee retention tax credit, because it seems like we got some questions on that. It says, you mentioned it's not a simple pull of your financials. That's quite complicated. As a small business owner, how much time should they allocate to gathering all the documents? Like how much work is it? But I know it's worth it, but we want to get that balance, right?
Well, it is complicated. There's a lot of rules there. You first got to make sure that you're eligible and all that. I would say go ahead and contact Samantha Paxton at One Eastside, and she can set you up and connect you with me, because One Eastside will actually pay for the first 2 hours of advising with that. And so what would happen then is we would have a quick call. We'll verify your eligibility there, and then see what it may look like for your organization. For some orgs, it may be very little and not worth the time and effort, honestly. But for others, it may be worth it for sure. And so then we can kind of talk about what those next steps would be. You may have a third-party payroll provider that you can actually work with and just put like a simple code into your payroll system, and then they can do it for you. So it may be something super easy like that. Or you may have something more complicated and need some more assistance. And it really just depends on what other stuff that you have going on. If you have a PPP loan, also, if you got restaurant funds, and how many employees that you have. But yeah, the rules are very complicated and overwhelming because the IRS's website is not up to date.
Got it. All right. So here's another question. It says, if I purchased equipment or services from a state with no sales tax, am I responsible for determining the amount of sales tax to pay?
Oh, everybody wants to go down to Oregon and buy stuff. I know. Well, technically, yes, you are responsible for doing that. The Department of Revenue will come after you if it's large enough. They have their own ways of finding you, I will say. And so, yes, technically you are required to do, I think it's called a use tax form. I don't know if Lily, if you're familiar with that. And yeah, you're technically supposed to come clean and do it. And again, if it's a very large piece of equipment with large dollars at stake, yeah, you probably want to do that, honestly. Or you can take your chances and see if they come and get you. But they do have mechanisms in place where they are working with out-of-state companies to make sure that you are paying your proper taxes.
Got it. All right. We have another question up here in the Q&A portal here. It says, question on forgiveness. Is there a deadline for applying for forgiveness?
Technically, no. You don't have to ever apply for forgiveness if you don't want to, but just know that within, what is it? Now I'm totally drawing a blank. 6 months, or I think it's 6 months after your covered period ends. So your covered period goes up to 24 weeks for your PPP loan, starts the day that you got funding. But within 6 months after your covered period ends, you are required to start making payments. And so that's kind of why people do sort of give themselves a timeline for when they have to go and apply for forgiveness. I'll say forgiveness is going through really quickly right now from the SBA. We're seeing people get the decision within the same week, which is insane. I mean, it's just, they're just like rubber stamping, I feel like at this point. They still go through their due diligence and stuff like that. I will say too, though, that things are going through really quickly, but don't think that you are over and done with and can start shredding all your documents and things after the fact. Definitely keep records of what you submitted for forgiveness, because the SBA has the authority to come back and audit you later on. And I can't remember the exact time frame. I think it's 3 years, maybe a little bit longer. So just keep your records there, because we are starting to see some of that kind of post-approval inquiry happening.
All right, great. Another question on employee retention tax credit, and this one is really related to family-owned businesses. So can I claim the ERC for my family-owned business?
Possibly yes, but it depends on who is employed there. So if it's just, mom and dad that are employed there, then they may not be eligible for the ERC. There are some specific rules there on ownership, and majority owners generally are not eligible for the ERC. And sometimes there's family attribution stuff that comes into play here. And so that's where we would meet with you and just kind of gather all the facts there and see what's happening. If you have a separate third party that you have hired, maybe it's a restaurant, mom and dad work at the restaurant, but you have 3 other wait staff people there and a cook. So now you have 4 people that are unrelated to you on payroll. For sure, those 4 people could probably qualify as long as you met the eligibility requirements for the ERC.
Oh, that's good to know. All right, our next question, let's see, it says, is there somewhere I can find a list of tax deductible business expenses?
Lily, I'll let you answer that one.
Well, like I was saying, that you could, always look at the Schedule C or, the form, whatever your business entity is, you can see the expenses that you can take, but those are just some common expenses, but there are, you can always do a Google search. I'm trying to think if I have anything like that, like a list of deduction. I have a tax organizer that shows you, like on my website, some deductions that you can take as well. You can find that on the resource page.
All right, great. There's another question on that same note. Can I write off car insurance for my business vehicle?
So I was saying that you can either do actual expenses where you keep all the receipts, or you do the standard mileage rate. Either or, you would still need to track your mileage, right? So your beginning and the ending odometer. So with insurance, yes, insurance, repairs, maintenance, all of that, oil changes, you can deduct. But like I said, you might want to work with a tax professional to see, is it better to do the actual expenses, or should we do the standard mileage rate? So
that makes sense. So, but it's an either or, you can't do both, because if you do the mileage rate, it covers all of those expenses, so you don't have to itemize it. Is that correct?
It's either or on that one vehicle.
Okay, got it. This is a question we were talking about. I think, Sarah, you're talking about filing taxes in different states if you have employees. Are there due date extensions for state taxes or only federal taxes? So if this is new information to folks, they might be a little bit like, oh my gosh, Where do I go find this information? What should they do?
Yes, states have their own due dates, which are not necessarily the same as the federal due dates. And some states have automatic extensions that you file your federal extension and it automatically does the state, and others require a separate state extension. So, I mean, you're basically dealing with 51 different jurisdictions, if you count DC too, with 51 different set of rules, and it's extremely frustrating. And so if you have a state tax situation, definitely seek out professional help. Because it's not always easy to navigate the state's website, and some states honestly are more aggressive than others, and so that may come into play too as to what your decisions are. I mean, if you have an employee in some random state where they're not known to be aggressive and they're only going to be there for a month, maybe it's not worth it to go through the whole extra hassle there. But I mean, if anybody's going to California, you definitely better make sure that you are in a full compliance there with all the rules there.
So talking about compliance, one of the questions here is, do I need to keep track of anything on paper if I use a system like QuickBooks? So what, for tracking for these type of scenarios, what would you recommend?
Yeah, so I mean, you have QuickBooks, yes, you want to have that system, but you also want to keep your bank statements, your receipts, because in case of an audit, whether it's the state or the federal IRS, they can audit you and you need to show them, it could be paper or it could be digital. So you can put in the cloud or, on your drive or whatever is safe. But you need to keep copies of these. I strongly recommend, and you can go onto my resource page of how long you should keep the documents, because the IRS can audit you the past 3 years. If there's fraud, they can audit you as long as you had your business. So yes, so keep records of receipts, bank statements, invoices, anything like sales receipts and things like that. Yeah.
But so I'm just going to be very clear, so that you can take a receipt and scan it and put it in the cloud or keep a copy of it, and that is sufficient enough. They don't have to keep boxes and boxes for perpetuity. Is that right? Okay.
Yeah.
All right,
and
perfect.
make sure that you're actually, like, if you're keeping online bank statements, make sure you're actually taking those bank statements and downloading them to your own system, whether it be the cloud or some backup hard drive or something like that, because I know that a lot of banks and online utility companies and stuff, they only keep those online statements for a period of time, and it may be an extra fee to you or something to try to get that bank statements from 5 years ago. So make sure that you just have a local copy actually downloaded rather than relying on that third-party vendor to keep it for you.
It's a good tip. Good tip. All right. So next question has to do with deductions, or a loss, I guess. Can I claim a loss for a job that I did and did not get paid for?
Are you talking about like debt?
I'm imagining someone was contracted to do a particular task or job, or they were asked to do it and they were supposed to get paid, but they didn't.
So my understanding is bad debt cannot be a deduction. Is that what you also understand? So I always thought it was, and then I've kind of worked with other accounting firms, and my understanding is bad debt is not something that you can write off. And I have an article for that.
Okay, so we like articles and further research, so I love it. We got lots of links, of course, into the chat. Oh, Sarah, were you gonna add something?
Yeah, I think it just depends on what type of expenses too that they're trying to write off. I mean, if they performed, they invoiced a third party for $1,000 for their services but never got that $1,000 paid, that's the bad debt situation. If they thought that they were going to work and do carpet cleaning for somebody, and so they bought a new piece of equipment because it needed some special situation there, or they bought some cleaning supplies, but then that person never actually fulfilled their services or something like that, then that would be more of just a business expense and fall within their normal business expense deduction limits.
Got it. All right. So this next question brings us back to the employee retention tax credit. It says, am I eligible for the ERC if I received funds through the Paycheck Protection Program and the Restaurant Revitalization Funds? Sarah, I think you may have covered this in your presentation, but let's remind everybody that what the answer is.
Right. Great question. So initially there was an exception out there that if you got the PPP loan, you could not get the ERC. That has since been changed, and it's retroactive all the way back to when that first COVID relief bill happened in March of 2020. So that is a very important change because there's a lot of misinformation still out there on the internet, old articles that haven't been updated and things like that. So if you got a PPP loan, yes, that may still make you eligible for the ERC. It doesn't automatically disqualify you. Same with the RRF funding or SVOG grants. Those won't automatically disqualify you. And the great news is that back in August, we got additional guidance from the IRS that said if you got those kind of fundings, then they're not part of your gross receipts calculation. So some organizations are eligible for the ERC because of being subject to some sort of government order. Others are eligible because they have a gross receipt drop when compared to 2019. But when you get those PPP funds or the restaurant revitalization funds, that's a big flux of money coming in. And so that can sometimes ruin your eligibility there. But the IRS has been nice here and said you actually don't have to include those types of income when you're doing your gross receipts test. So yes, definitely check it out. Feel free to contact us through Samantha and we can help have those conversations too. And even with the RRF funding, there are some special opportunities available there where you can actually double dip on wages for RRF as well as the ERC. So there is some unique planning opportunities there.
Wow, that's amazing. Well, we're down to our last few minutes. I wanted to circle back with you both. If you can give kind of like your final comments and kind of like words of advice or wisdom for our participants, that would be great. And Lily, I will start with you.
Yeah, so with my presentation, I highlighted know your business entity because that's important on how to do your bookkeeping and knowing your tax filing due dates. If you're doing your bookkeeping yourself, remember to get it reviewed. I cannot express to you how many times I have reviewed my clients' books and finding out that they filed incorrect tax returns because their books were a mess. So, to get in compliance, make sure your bookkeeping is done correctly, and then you can file an accurate tax return.
All right, Sarah.
I would just say, remember to breathe. there's going to be a lot of confusing things that happen in the coming months ahead. A lot of things where you're like, I don't know how to do this, or what, that's taxable and I never thought it was supposed to be. Or, there's going to be a lot of situations like that. And just remember to breathe, have patience with the people that you're working with, and do definitely seek help if you have questions, because there again is so much that has changed with these laws over the past 2 years, specifically regarding COVID relief funding. And Google is a great resource, but it can also be a very confusing resource right now because there is so much misinformation out there, or the articles haven't been updated for new law changes and things like that. So definitely seek extra help when you need it. And again, remember to breathe.
I love it. And I would say my words of wisdom is reach out to One Eastside Spark, because we are a hub of information. We have a lot of information on our website, of course, that you can access at your own time. But we know as small businesses, you're very busy. And if you want to reach out to Samantha and we can help guide you to the best of our ability, we would love to do so. Because again, all these advisors that we have are paid for through a federal grant that we received, and it is at no cost to you. So that's my little final words of advice. And we actually had one more question, which I think we can slip in the last minute here. And it might be an easy one. It says, do you think they will extend the federal tax deadline this year for the annual tax return?
I hope not.
Oh.
Lily, I agree with you too. I hope not. I think the chances are slim. I don't think that the IRS likes doing it, honestly, but they will if need be. I mean, if we have some new variant come up and it's wreaking havoc and it's just like what we're dealing with right now, it's very likely that they could, because they just want to make sure that people can file on a timely basis. And the IRS doesn't want to have to issue all these late penalty notices either. But stay tuned.
Yep. But in the meantime, get prepared.
Right.
I think that's the name of the game, right? All right. Well, thank you all, Lily, Sarah, for giving us your time and expertise today. We really appreciate everything in this whole presentation. I remind all our participants, we are recording this webinar and we will send a link to you as soon as it is available. I want to say thank you again to all our partners on the East Side who are working hard to support our business community. And I want to make sure you bookmark our website, www.oneeastside.org/spark. There you will find key resources, information on our no-cost one-on-one advising, our recordings of our weekly webinars, and grant opportunities as they become available. And a big thank you to all of you for participating in our webinar today. So until we see you again, this concludes our event. Thank you.